Welcome back to our finance channel, where we simplify money, investing, and wealth building strategies for everyone. If you are new here, make sure to subscribe and turn on the notification bell so you never miss our latest videos. Today we are going to discuss one of the most important and commonly asked questions in investing: index funds versus mutual funds. Many beginners get confused between these two options and are not sure where to put their hard-earned money. By the end of this video, you will clearly understand what index funds and mutual funds are, how they work, their differences, pros and cons, and which one might be better for your financial goals. Let's start with mutual funds. A mutual fund is an investment vehicle where money from many investors is pooled together and invested in different assets such as stocks, bonds, or a mix of both. These funds are managed by professional fund managers whose job is to research the market, analyze companies, and make decisions about which securities to buy or sell. The main goal of most mutual funds is to beat the market and generate higher returns than a benchmark index. Because of this active decision-making process, mutual funds are often called actively managed funds. Investors buy units of the fund, and the value of those units goes up or down based on the performance of the investments held by the fund. Now let's talk about index funds. An index fund is also a type of mutual fund, but it follows a completely different strategy. Instead of trying to beat the market, an index fund simply tracks a specific market index, such as the S&P 500, NASDAQ 100, Dow Jones, or in some countries, indexes like Nifty 50 or SEC. The fund invests in the same companies that are part of that index and in the same proportion. There is no active stock picking or frequent buying and selling. The goal of an index fund is not to outperform the market, but to match the performance of the index as closely as possible. This approach is known as passive investing. One of the biggest differences between mutual funds and index funds is the management style. Mutual funds are actively managed, which means a fund manager and their team constantly study market trends, company financials, and economic conditions to decide where to invest. They try to take advantage of opportunities and avoid losses by adjusting the portfolio. Index funds, on the other hand, are passively managed. They follow a fixed set of rules based on the index they track and do not require constant decision-making. This makes index funds simpler and more predictable in terms of how they operate. Another major difference is cost. Because mutual funds require skilled managers, research teams, and frequent trading, they usually charge higher fees, known as expense ratios. These fees are deducted every year from your investment and can significantly affect your returns over the long term. Index funds have much lower fees because they do not need active management or constant trading. Over time, even a small difference in fees can lead to a big difference in how much wealth you accumulate. Lower costs are one of the strongest advantages of index funds. Performance is another key point to consider. Many people believe that active mutual funds always perform better than the market. But in reality, research has shown that most actively managed mutual funds fail to beat their benchmark index over the long term. While some funds may outperform for a few years, very few are able to do so consistently over decades. Index funds, by design, deliver market returns. Historically, markets have grown over time, and by simply matching the market, index funds have provided strong long-term results for investors. Legendary investors like Warren Buffett have often recommended index funds for most people because of their simplicity, low cost, and reliable performance. Risk is also an important factor. Both mutual funds and index funds are subject to market risk, which means their value can go up or down depending on overall market conditions. However, mutual funds carry an additional type of risk, known as manager risk. If the fund manager makes poor investment decisions or changes strategy at the wrong time, the fund's performance can suffer. Index funds do not depend on individual decisions, as they simply follow the index. They are highly diversified across many companies, which helps reduce the risk associated with any single stock performing badly. Transparency is another area where index funds often have an advantage. Since index funds track a known index, investors can easily see which companies the fund holds and in what proportion. The holdings only change when the index itself changes. In mutual funds, holdings can change frequently based on the manager's strategy, and it may be harder for investors to know exactly what the fund is investing in at any given time. For beginners, transparency makes it easier to understand where their money is going. Simplicity is something many new investors value. Index funds are very simple. You invest regularly, hold for the long term, and let compounding do the work. There is no need to constantly monitor performance or switch funds. Mutual funds may require more attention, such as tracking how the fund is performing compared to its benchmark, understanding the manager's strategy, and deciding whether to stay invested if results are disappointing. For people who want a hands-off approach, index funds are often more suitable. Let's now look at the advantages and disadvantages of mutual funds. One advantage is the potential to outperform the market. A skilled fund manager may be able to identify undervalued stocks and generate higher returns, especially in certain market conditions. Mutual funds also offer a wide range of strategies, such as growth, value, income, sector-specific, or international investing, which can be useful for investors with specific goals. However, the disadvantages include higher fees, inconsistent performance, dependence on manager skill, and sometimes lack of transparency. Over long periods, these drawbacks often outweigh the potential benefits for most investors. Index funds also have their pros and cons. Their biggest advantages are low cost, broad diversification, simplicity, and strong long-term performance that matches the market. They are ideal for beginners and for people who want to build wealth steadily over time. The main disadvantage is that index funds will never beat the market. They will only match it. When the market goes down, index funds will also decline. There is also less flexibility to take advantage of short-term opportunities. However, for long-term investors, these drawbacks are usually acceptable. So which one should you choose? The answer depends on your goals, risk tolerance, and investing style. If you are a beginner, want a simple strategy, prefer low fees, and are investing for the long term, index funds are often the best choice. They allow you to benefit from overall market growth without the stress of picking winners or worrying about manager performance. If you have more experience, are willing to research funds, and believe in the ability of a manager to outperform the market, you might consider mutual funds as part of your portfolio. Some investors also use a combination of both. Let's take an example to understand the impact of fees and performance. Imagine two investors each invest $10,000 for 30 years. One invests in an index fund with an average annual return of 8% and very low fees. The other invests in a mutual fund that also earns 8% before fees, but charges 1.5% in annual fees. Thank you for watching this video. If you found it helpful, please like and share it with your friends and family who want to learn about investing. And don't forget to subscribe to our channel for more videos on personal finance, saving, investing, and building a better financial future. See you in the next video.